Factor cost versus market prices. The production and income approach measures the domestic product as a cost paid to the factors of production and is known as domestic product at factor cost. However, the various forms of final output, when considered from the point of expenditure, are valued at market prices, that is, the actual price which either the consumers or producers pay for purchase of goods and services, whether for consumption or for investment. This measurement is called the expenditure at market prices. When valued in this way, this measure will be different from the product or income measure at factor cost. Let's delve deeper into this argument to find the reasoning. As we know, money value of final goods and services produced can be estimated in two ways: at factor cost, that is FC, or at market prices, that is MP. Simply put, difference between FC and MP is net indirect tax. Net indirect tax is the difference between indirect tax and subsidy. Factor cost. It refers to all factor payments made by producing unit or firms to the factors of production involved in the production of goods and services. It is called factor cost because it is the cost incurred by the producer or the firm who pays the factors in the form of rent, wages, interest, and profit. That is, rent for land, wages for labor, interest for borrowed money, that is capital, and profits for undertaking risk involved in production process, a reward for entrepreneurship. Market price. Market price is a price at which a commodity is sold and purchased in the market. The point to note here is that when a product goes to the market for sale, government levies indirect tax like sales tax, excise duty, etc., which is added to the factor cost of the commodity. Similarly, sometimes government gives subsidy on sale of certain commodities like kerosene, oil, sugar, rice at ration shops, which is subtracted from factor cost. As a result, market price becomes higher than factor cost in case of levy of indirect tax. Market price becomes lower than factor cost in case of grant of subsidy. In short, MP includes net indirect taxes, that is, indirect taxes minus subsidies, whereas FC does not. Let's put it in the form of equation. GDP at factor cost plus net indirect taxes, which is nothing but amount of indirect taxes paid by consumers to government minus amount of subsidies paid by government on behalf of the consumer to the producer equals to GDP at market prices.